Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from Blain and Company in New Bern, here's David Blain.
Hello, I'm David Blain. Welcome to All Things Money. For the next 30 minutes, we're going to take an educational, stimulating, and informative look at all things having to do with money. We'll take a look at everything from investing and taxes to real estate, and provide you some actionable ideas to help either preserve or maintain your wealth, or if you're just starting out, to help grow your nest egg. Remember, the show is about you and your money, so if you have any questions or topics you'd like addressed on the show, please feel free to give us a call during regular business hours at 252-633-0107, or feel free to email us at any time. The email is allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And if we'll try to address your topic or question on a future show. So tonight we're going to pick up a theme that we touched on from a previous show, and that's namely how the dollar affects your investments. And you probably hear on the news, and then maybe you read in the newspaper, the dollar is up, the dollar is down. You know, what exactly does that mean, and how does that affect your investments? Well, tonight we're going to talk about a few things having to do with the dollar, and a little bit about what these topics mean. So one thing we'll talk about, you hear terms a strong dollar and a weak dollar. And what a strong dollar means is that the U.S. dollar is appreciating against foreign currencies, such as the euro or the yen. Within the world, different governments and businesses, they actually trade currencies with each other. So when they're purchasing products from the United States, they need dollars to pay those products. You know, your local exporter, from New Bern that makes a product and sends it to Japan, well, he doesn't want yen. He can't go to, Food Line and buy groceries with yen, so he needs dollars. So what that does is the countries overseas, they have to trade their yen for dollars on the foreign exchange market. And so when the dollar is strengthening, it means that the dollar is rising against the foreign currencies. If the dollar is weakening, it means that the dollar is worth less for each yen or euro overseas. And the implications for this is a strong dollar makes our products a little bit more expensive overseas, and it makes foreign goods cheaper in the United States. Whereas a weak dollar makes our exports relatively attractive overseas and makes it more expensive for foreign companies to sell their products in the United States. A perfect example of this is traditionally, in the 90s we had a very strong dollar, and a lot of our manufacturing was being moved overseas, and we were importing a lot of our products. Well, actually, as the year 2000 and the past several years, the dollar has been weakening significantly. And one of the most notable examples is a lot of the car manufacturers now find it cheaper to build a plant in the United States, employ United States workers to have us buy their cars here. So that's a benefit of the weak dollar. But what I want to talk about tonight really is that myself and other economists generally advocate not for a strong or a weak dollar, but a stable dollar. A lot of the problems that we run into come in when the dollar value keeps fluctuating. It makes it very difficult for businesses to plan for the future, as well as governments, frankly, as well. One of the things that is important to understand is the Fed. You've heard of the Federal Reserve, Chairman Ben Bernanke. And the Fed affects the dollar policy by either tightening or loosening monetary and fiscal policy. And so they control some of the short-term rates, the rates at which banks will loan money, or the Fed will loan money to member banks. So they control that interest rate, and by raising it or lowering it, they can increase the money supply by encouraging banks to lend, or they can tighten it. And so they have some control over the dollar. And how does that impact your investments? Well, we already talked about when you're investing overseas, how the dollar affects it. Well, I want to bring it a little bit close back to home. And when we look at through the years, the Fed policy, for the most part, has resulted in a very weak dollar. Starting in if we look at 1914 as sort of a dollar being worth a dollar, over the years, the policies of the Fed have caused the dollar to significantly weaken to where today, as of December, that same the dollar in 1914 is only worth about 5 cents. So the dollar has lost about 95% of its value, coincidentally, over about the past 95 years. And so this is definitely a weak dollar policy. It's a policy that has gone on for years. And so what happens is, in conjunction with the falling dollar and rising tax rates, is people just do not have the wealth that they used to. And it can be very bad for the United States economy. It's one of the reasons that as people get older and they get more conservative, they want to put all their money into CDs or low interest bearing bonds or keep it in the bank. And it's one of the reasons that we don't advocate for this type of strategy, simply because of the decline in the dollar. As inflation rises and the value of the dollar declines, you simply cannot purchase the same amount of goods and services that you used to. You know, we've all heard the stories of our grandmother or mother saying, well, you know, a gallon of milk was 5 cents. And I remember as a child, gas, you know, being 20 or 30 cents a gallon. And so this is a combination of inflation, rising prices, as well as the decline of the dollar. And so if you're planning on your money lasting for a long time, when you're investing, you have to plan on inflation and the decline of the dollar. I don't see this policy changing anytime soon. And so the risk that people have as they grow older is actually that they are too conservative in their investing. It's funny, I like to tell a story. My grandfather lived in a town called Newark, Ohio, and he worked for the Ohio Department of Transportation all his life, and when he retired, he was a carpenter. Well, he had a nice home in Newark that was paid for. He had a nice little cabin up on a lake, Leech Lake up in Michigan, and he also had about a 20-acre piece of property out in the country with a pond and a nice little cabin. And my point in saying this is, he wasn't someone that was wealthy. He didn't do anything remarkable in his life, but because of the lower tax regime and the fact that the dollar had not gone into such a rapid free fall, he was able to afford, you know, relatively nice lifestyle on a small amount of money. And that type of thing is just not possible anymore due to the declining dollar. So that takes us into our first break. When we come back, we'll take a look at some things having to do with investor sentiment and how that affects the markets. As a reminder, if you have any questions, feel free to email us at allthingsmoney@dlblain.com or give us a call at 633-0107.